Another day, another video, a step closer to the dollar. Whenever I'm having tea, I need the cup to be as big as possible because of the tea I'm also about to give you. Welcome to the strategy session. In this segment, I'll be giving you guys and teaching you guys some dope strategies. Now, how can you help me? You can simply help me by liking the video and subscribing to the YouTube channel. Disclaimer. This is not financial advice. This is for educational purposes only. But before anything, 5 seconds for the load. Load. Open our minds with wisdom and clarity. Make every lesson simple, sharp, and life-changing for everyone watching this video. Amen. I'm cooking. Two keys to success in the broker business. You gotta stay relaxed. Welcome to the strategy session. Today I will be breaking down the famous ICT and smart money concepts in the simplest, cleanest way possible. No charts, just pure understanding. By the end of this video or segment, you'll finally know what people mean when they talk about order blocks, liquidity, fair value gaps, and all of that. Now let's get into it. First things first, market structure. Think of it as a storyline. Every chart is either moving up, down, or sideways. When the market is making higher highs and higher lows, that's bullish. When the market is making lower lows and lower highs, that's bearish. But the most important part is structure. That moment when price breaks the previous high or the previous low, that's often the first sign that price is changing direction, or rather, the trend is changing. Smart money loves entering just after these moments. So it's very important to understand market structure. Secondly, liquidity. Liquidity is simply money lying on the chart. It's where people would initially put their stop losses. And trust me, institutions know where your stop losses are. That's another reason why I don't trade stop losses. But I monitor my trades. Also, another thing, please don't use this mindset. Please don't use this mindset. But me, my stop loss is the whole account, chief. I mean, already when you deposit, you know that you're gonna lose the money, right? But I mean, risk management should be a thing. Just monitor your trades. Just make sure you're not liquidity. Just make sure you're not liquidated. Yeah, but what is liquidity? Above previous highs, liquidity. Below previous lows, liquidity. Equal highs or equal lows, that's a buffet of liquidity. Trend lines, that's liquidity in a straight line. But why does this matter? Before price makes a move, it loves to go to those stops. Like, take your money. You know, that's the market makers. They want to take your money the very same way you want to take their money, right? What does that then mean? It grabs the liquidity, then moves to the true direction. So yeah, that's liquidity. Now my favorite order blocks. Oh, I love order blocks. If you know by now, I have a model called the high price model. Order blocks are the key concepts of that strategy. Now, what is order blocks? Order blocks is the last footprint that price makes before making the real move. Now we have a bullish order block and a bearish order block. A bullish order block is the last down candle before price pushes up. A bearish order block is the last up close candle before price pushes down. These areas are powerful because this is where institutional orders will normally lie. Now, price will return to them. No, price will always. Price should go to them because that's where institutional orders lie, right? Yes. So I think it's safe to say price will always go to the order block. Well, not always, but it will always, like most of the time, go to your order block. So whenever you see price returning to an order block, it's not random, it's intentional. So like order blocks are very so if price is pushing up, the last down candle is your order block. But it's very important that your order block has a fair value gap. Now, what is a fair value gap? Fair value gaps happen when price moves too fast, leaving behind an imbalance. Now, think of it as price skipping a step. That step is a fair value gap. But remember, it's very important for the market to be balanced. So even if price goes up, if it leaves fair value gaps, it needs to come back. Okay, not needs to. It will come back. Well, most of the time, it will come back and fill those gaps because those gaps are essentially liquidity. And that's why most of the time you see traders waiting for price to drop a bit into those fair value gaps before taking trades. But now, from my experience of trading, fair value gaps are very tricky. They're good, but you can take a fair value gap when there's no order block in the ranging market. Let's say your order block has already been respected, but if you have an unrespected order block and you take a fair value gap that's not before the order block, you might as well just consider that as an inducement. We'll talk about an inducement. So I like to take order blocks. I take fair value gaps. I take entries using fair value gaps if I'm chasing price. So meaning that if my order block has already been respected, I can take trades or chase price using a fair value gap. That's how I like to use a fair value gap. Now I want us to talk about a breaker block. Now what is a breaker block? A breaker block is an order block that's violated. In most cases, or rather no, yeah, in most cases, the order block will be violated by a fair value gap. It's very important for the order block to be violated by a fair value gap. Sometimes it will be violated just by price, but I prefer breaker blocks that are violated by a fair value gap. So technically what I'm saying is that a breaker block is an order block that failed. So breaker blocks are very dope reversal tool. So whenever you have an order block that's not respected, you will essentially just reverse it. Say you had a bullish order block, you will just essentially just reverse it. If you had a bearish order block, you will obviously price is gonna break above that order block, break above, and then you have a bullish setup now, meaning your trend is now bullish. And in that case, you should have what? A market structure shift. Yeah, and remember you had a fair value gap. It's very important to have it's very important for your order block to have a fair value gap. So if you have a breaker block, that means you had an order block previously, you know. Yeah. Now my favorite that makes me stand out whenever I'm having conversations with ICT traders, BPR. Most traders don't know about the BPR. You know, if you want to sound like you know your stuff, just talk about the BPR. But besides that, BPRs are very, very dope. Yeah, they're very dope. The high price model also includes the BPR. Very dope. Now, what is a BPR? A BPR is a balanced price range. Price is balanced. Now, in this case, the price will maybe give you a bullish fair value gap, then give you a bearish fair value gap in the same region. So your fair value gaps will allow you to place a zone. That zone price is balanced. But then, from my experience of trading, price will always, cannot always, but price will come back to your BPR. So in most cases, I do use BPRs as an order block, and yeah, so most of the time you will have price giving you a V, a V. That V, most of the time, that last candle is your order block, and above that V, let's say above that order block, you have a fair value gap and a fair value gap, balanced price range, and in most cases, you're gonna have another one and another one. So you could have a BPR and a BPR and a BPR and an order block. Then it gives you a breaker block. So in this case, you have an order block. You have
Be nice. I'm finding it.
You have a breaker block. You have BPRs and an order block. Where is price likely to turn? This is not the video about that. Keep watching the videos. I'll teach you guys about that as well. So in my opinion, price reacts to the BPR with precision. It's very dope. Very dope. So another thing to understand about price is that price has discount and premium zones. In discount zones, you look to buy. In premium zones, you look to sell. So it's just 50%, 50%. If you have your Fibonacci, you can have a movement, a trend. You're gonna have a high and a low. So 50% of that range is premium and discount. So if you have a range market, 50%, the low 50% is your discount, and the above of that range is the premium. The discount, you look for buys. The premium, you look for sells. Smart money never buys high and they never sell low. So whenever price is high, it should come and sell. Why? We need the market to be balanced. So in the midst of price balancing, you can use price is going to give you structure shifts. It's going to give you BOS, break of structure. It's going to give you fair value gaps. It's going to give you order blocks. You can also predict those things using Fibonacci. We're going to make a video about Fibonacci as well. So stay tuned, subscribe to the YouTube channel, and like this video. Now, liquidity pools. What is liquidity pools? This is often an area where people place stops and orders, right? For example, it's equal highs, lower lows, psychological levels being 0 or 50s, weekly highs and weekly lows, and previous day lows and previous day highs. Liquidity pools attract price like magnets, so it's very important to understand that price is moved and delivered by liquidity. So price will always fetch liquidity. Right. We also have mitigation and mitigation blocks. Mitigation is when price moves to a zone where it will close some positions and stop others, being it fetching your trail stops. This is why you often see price giving you order blocks and breaker blocks when it returns, when it retests. That's also where the high price model was where it was discovered from. Actually, now that I'm thinking about it, the high price model is actually a mitigation model. Yeah, find out. Now that I'm thinking about it. Yeah, guys, I can't wait to give you guys the high price model. Very dope. Very dope. But am I gonna do that? I don't know, but I should. Yes, I should. Why am I giving back the high price model? I'm gonna give it back so that I can go quiet about my trading stuff. Yeah. The goal is to be rich and underground. You know what I'm saying? Now we have inducement. Inducement is a trap, it's a fake move, it's a bait. That zone will rage bait you, and you will get rage bait. Rage bait. Rage bait. Rage. Whatever. Yeah. Bangomere. Bangri. So inducement will essentially just trap traders to enter the market early. So in most cases, you will have an order block and an order block. So you will have an order block just before another order block. So if you don't see the other order block, you're going to take trades from the order block that you see. Now you will be induced into the market early because there's still another order block. So inducement will come in a form of equal highs and equal lows and a fake breakout. So what's the whole point of inducement? Inducement is there to create liquidity so price can take them and move properly. Oh, I'm getting exhausted. We also have displacement. Displacement is when price moves in a certain direction with a very strong move. And that move often shows institutional order flow. And in most cases, you'll find displacement just after a market structure shift. And whenever you see displacement, just know institutions are active. Yeah, orders are meaning in most cases you must watch how price reacts to an order block. See, when price moves very fast on an order block, and you'll see this most of the time on the 1 minute time frame. That's why I trade. That's not the reason why I trade, but the 1 minute is very dope. You also have the high price model on the high price is just too good, guys. Too good. Now we have time zones. We have time zones. Time zones will be explained in the next video. Yes, in the next video, we will be talking about the AMD, but I won't necessarily be talking about how price reacts. But we have the AMD. I'll be talking about the power of 3. But what I can say to you is that when you combine structure with time and liquidity, your accuracy immediately increases. And that right there is the smart money blueprint. These concepts aren't random. They fit together to show you how price really moves. And if you enjoyed this session, make sure you leave a like and subscribe so you don't miss the next strategy session. And if you want a deeper episode where I break down examples or setups about these concepts, let me know in the comments. Sure. We have sessions as well, the AMD, also known as the PO3. PO3, power of 3. The power of 3 is the AMD. Accumulation, manipulation, and distribution, right? So we have sessions, right? We have the Asian session, the London session, and the New York session. So